Nebius Group reported third quarter financial results, and despite the positive figures and incredible growth numbers, the stock price is falling after the announcement. CoreWeave also experienced a similar decline in its share price after reporting quarterly financial results, and it's partly due to high investor expectations about these companies that are building out the infrastructure that supports the growth of artificial intelligence computing. In this video, I'm going to review Nebius's latest results and update my buy, hold, or sell rating and share with you my fair value calculation on what I believe is a fair price to pay for this stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So Nebius provided a few significant investor updates. Most notably, it said that it expects $7 to $9 billion in expected annualized revenue run rate by the end of 2026. Now, this doesn't mean that they expect to generate $7 or $9 billion of revenue in 2026. What this means is they expect to reach an annualized run rate, which means roughly $700 million in revenue by December of 2026, recurring revenue. And so if you annualize that, that'll bring you up to about the midpoint of this expectation here. So they expect to continuously increase their annualized revenue run rate or the recurring revenue to reach that point by the end of next year. They also updated their contracted power total. Previously announced they had 1 gigawatt expected. They now expect over 2.5 gigawatts. And Nebius echoed the sentiments that I've been hearing around all of the AI companies and those that are providing the computing for the support of this technology. They are sold out of all available capacity. Sold out. And several companies I don't hear them saying sold out, but it's similar, right? Amazon, Alphabet, Microsoft, these cloud service providers, they all told investors that demand exceeds supply. So it's kind of like saying it's sold out, right? But what they're actually saying is that demand exceeds supply. And Nebius Group is saying that they're sold out of all available capacity. And so you can understand why they're spending so much to build more capacity. Their adjusted EBITDA margin came in at 19%, but they generated a whopping 355% year-over-year revenue growth. Its core AI infrastructure business grew at 400% year-over-year. Of course, Nebius Group has other business segments, including AV Ride, which is driverless car technology, but the core of its business is the core AI infrastructure, and that's soaring. And I mentioned they're spending a lot of money to build this infrastructure, so they've secured funding $4.3 billion in convertible notes and equity offerings in September of 2025 alone to help build all of that infrastructure they need to build in order to support all of their customers that are continuously coming back and asking for more and more computing power. So the CEO noted again that once again we sold out of available capacity in Q3, a consistent trend during the year reflecting strong momentum. In September, they announced their first large enterprise AI infrastructure win with Microsoft in a deal valued between $17.4 and $19.4 billion. We are fully on track to execute this contract and expect revenue from this deal to start ramping up throughout 2026. So this is one of the deals that's given the company confidence to provide that investor update, suggesting an $8 billion revenue run rate by the end of next year. They also announced their second large AI infrastructure deal, this time with Meta Platforms. The agreement with Meta is smaller, valued at approximately $3 billion with a 5-year term, and over the next 3 months, they plan to deploy the capacity needed to serve this agreement. In fact, demand for this capacity was overwhelming, and the size of the contract was limited to the amount of capacity we had available. In other words, saying if we had more capacity, we could have signed a bigger contract and generated more revenue. The CEO goes on to say, we will continue to aggressively ramp up capacity to be able to serve these large deals as well as to serve their core customers, startups, and enterprises. So I mentioned they have the driverless technology segment, AV Ride, and they were pleased to welcome Uber as a new strategic investor. So driverless car technology, I've been saying that this could be the next catalyst for growth for computing requirements and computing power. And I've been talking about this for NVIDIA specifically. When the growth in these data centers optimized for AI starts to slow down, which probably won't happen until at least another year, maybe 2 or 3 years. And then at that point, driverless car technology could be maturing, could be expanding, and at that point, it could be the next catalyst to drive computing power and the needs for data centers and the needs for more computing to support the growth of artificial intelligence. And that's essentially what driverless car technology is. Artificial intelligence is driving the car for you. So they go on to say the only real limitation on our revenue growth has been the amount of capacity that we've been able to bring online. Basically saying that we have enough orders and we have enough demand. As much as we can bring online, as much as we can make available, our customers are buying it up. Now, that's not going to be the case forever, but it's the case right now, and it has been the case for over a year now, probably closer to 2 years, where demand for this computing power exceeds supply, and that's true for nearly every company that's operating in this industry. So last quarter, they guided for 1 gigawatt of contracted power by the end of 2026, and they're currently in the process of securing additional sites that would bring their total to approximately 2.5 gigawatts by the end of 2026. So they're seeing such insatiable demand that they want to accelerate their investments to bring more supply online more quickly. Of this amount, they expect to have about 900 gigawatts of contracted power. That means, connected power. That means these are power connected to built data centers by the end of 2026. So Nebius Group is scaling quickly, has orders, and demand is soaring. But what about valuation? Well, I covered the company and I initiated the rating on Nebius Group as a buy on October 22nd, 2025. What do I think about it following the earnings results? Well, the stock price is down over 7% following these announcements, and the current market price at $102 is still well below the intrinsic value per share I calculated and updated today at $144. So I will be reiterating my buy rating for Nebius Group stock, and I will remind investors that this should only be considered for investors with a very high risk tolerance. This is a high risk, high reward type of investment, one that could increase your wealth or decrease your wealth rapidly. So if you don't have a high risk tolerance, you shouldn't consider this stock for your portfolio. But for those of you that are willing to take on the elevated risk for the potential of excellent rewards, this could make an excellent addition to your portfolio. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.